Welcome to the research desk.
Imagine doing everything perfectly according to the textbooks.
Right, you buy what is mathematically cheap, you sell what is historically expensive. You follow the gold standard of value investing.
It is a philosophy that has built the greatest fortunes in financial history.
It really has. And yet, doing this within the S&P 500 costs you half your potential return. Today, we are investigating a mathematical paradox that strikes at the very foundation of how we build portfolios.
We are looking at contrarian investing, a strategy that works brilliantly in one environment and becomes a portfolio-destroying trap in another.
Even though the underlying logic remains entirely unchanged. Let us look at the reality of this performance gap. When we apply contrarian logic at the cross-asset level, rotating between broad equities, sovereign bonds, and commodities, it produces a highly resilient 0.94 Sharpe ratio.
You wait for the cycle to turn and you are rewarded with robust risk-adjusted returns.
But the paradox emerges when we take that exact same mathematical framework and apply it one layer deeper to the sector level.
Rotating between technology, financials, and consumer staples within the S&P 500 causes the strategy to collapse to a 0.52 Sharpe ratio.
We need to pause and quantify the sheer scale of this cost. If you simply bought and held the S&P 500, you captured a 15% annual return.
But if you attempted pure contrarian sector rotation, your return collapsed to 7.2%.
You paid a massive 7.8 percentage point annual penalty for trying to be clever. Now, my stance on this is rooted in the fundamental laws of market physics.
And I fundamentally disagree with that stance.
Well, let me explain. The failure at the sector level is not a failure of the contrarian philosophy itself. It is merely a failure of patience among the investors executing it.
A failure of patience?
Yes, patience. Expansions lead to contractions. Overvaluation leads to correction. A single sector cannot expand to consume the entire market indefinitely. Eventually, the cycle must turn, and when it does, the patient contrarian will be vindicated.
The failure you are describing has absolutely nothing to do with a lack of patience. It is a mathematical and structural impossibility for contrarian logic to succeed in the modern sector environment.
A structural impossibility? That is a very strong claim.
It is the reality of the data. You cannot outweight the underlying architecture of the market. What you view as a temporary anomaly requiring patience is, in fact, a permanent structural realignment.
But cycles always revert.
I want to break down exactly why that belief is a trap. We are going to examine the specific data underlying this collapse, and I will present the structural realities of market leadership.
I welcome the data, but the premise of waiting out a cycle is based on the undeniable historical reality of leadership rotation.
By the time we unpack the mechanics of catalysts, the mathematics of concentration, the reality of return distributions, the illusion of correlation, and the fundamental ambiguity of value itself, it will become evident that relying on patience is not an investment strategy.
Then what is it?
It is an exercise in capital destruction. Look, at the cross-asset level, we see leadership rotate predictably. Bonds lead during economic deceleration. Equities lead during synchronized global growth. Commodities lead during inflationary spikes.
That is true for cross-asset portfolios, yes.
Right, and this leadership tends to rotate every 2 to 3 years. It is a natural rhythm. Therefore, applying that same logic to sectors, underweighting the expensive ones and overweighting the cheap ones, is just standard prudence.
Standard prudence that costs you 7.8% a year.
Because they are impatient. If a sector has run too hot, its valuation becomes detached from its fundamental earnings power. The market mechanism eventually recognizes this detachment and forces a reversion to the mean.
To suggest that a cycle will simply refuse to turn contradicts centuries of market history.
Overvaluation creates its own gravitational pull downward.
Exactly.
Let us see what happens when that cycle refuses to turn. Let us use the exact data that exposes the flaw in applying cross-asset logic to equity sectors. You speak of leadership rotating every 2 to 3 years.
I do.
That is fundamentally false from modern equity sectors. Look at the period from 2016 through 2024. The technology sector did not just experience a good run.
It was a very good run.
It outperformed the broader index in 7 out of those 9 years. It established a structural trend of positive 3.9% per year above the index.
But it still has to correct eventually.
We must be absolutely clear about what happens to an investor positioned against a structural trend of that magnitude. When you underweight a sector because your model tells you it is expensive, you pay a daily mathematical penalty for every basis point it continues to climb.
I understand the drag, but
In 2020, the technology sector returned positive 43.9%. In 2023, it returned an astonishing positive 56.4%.
those are extreme outliers.
In 2024, it returned positive 36.6%. By positioning yourself as a contrarian during those periods, you absorbed a relentless, punishing drag on your portfolio.
But that drag is temporary until the turn.
The annual drag in 2020 was negative 11.0 percentage points. In 2023, the drag was an apocalyptic negative 15.8 percentage points.
Okay, 15.8 is painful, I admit.
In 2024, it was negative 11.0 percentage points again. This is the first critical reality we must establish. At the asset class level, leadership rotates cyclically. At the sector level, technology's reign has been undeniably structural.
So you were saying you cannot outweight a structural trend.
It is drifting aggressively upward. Your valuation model is waiting for a return to a baseline that no longer exists.
But what physically stops that overvaluation from correcting itself? Why does this reversion happen so reliably at the asset class level, but fail to materialize at the sector level?
Because of the nature of the catalysts.
Well, my perspective is that catalysts are an expression of market gravity. When valuations become excessively stretched, they eventually become too heavy to support themselves.
That is a romanticized view of market mechanics.
Is it? The market naturally corrects the imbalance. It does not necessarily require an explosive outside force or a dramatic news event. The sheer weight of capital concentration in an overvalued asset eventually exhausts the marginal buyer.
And then the asset begins to correct organically?
Exactly. The same should hold true for a sector that has compounded at 50% a year. Eventually, the pool of capital willing to pay those multiples evaporates, and the cycle turns inward.
The reality is driven by the stark difference between endogenous catalysts and exogenous catalysts.
Endogenous versus exogenous.
Yes. At the cross-asset level, catalysts are endogenous. They are self-generating. They make their own weather.
Give me an example of making their own weather.
Consider the physical flows of capital. Central banks mechanically purchase 1,100 tons of gold every single year to diversify reserves. The Organization of the Petroleum Exporting Countries actively manages the global supply of oil to engineer price floors.
So the catalyst is built in.
Completely. Passive retirement flows blindly pump $500 billion a year into the equity system regardless of valuation. Every time a worker receives a paycheck, a portion is automatically diverted into a target date fund.
Which mechanically buys the broad market.
Exactly. These forces are automatic. The catalyst for cross-asset performance does not wait for an invitation. It is built into the institutional plumbing of the global financial system.
And you are arguing the sector level operates differently.
It operates in a completely different reality. Sector catalysts are exogenous. They are entirely at the mercy of the macroeconomic environment.
So a contrarian buys the financial sector because it is statistically cheap?
But cheap financials do not spontaneously revert to the mean just because their multiple is low. They need a specific macroeconomic catalyst.
Like rising interest rates to expand their net interest margins?
Precisely. Without rising rates, they remain a value trap. A contrarian buys the energy sector because it is trading at a low historical percentile. But cheap energy needs a global economic expansion to drive an oil price recovery.
So what happens when the macro environment does not cooperate?
Specifically, when you are in a regime characterized by cooling growth and declining inflation, those cheap sectors do not revert to the mean. They just get cheaper.
That is a grim picture for the contrarian.
Patience without an exogenous macro catalyst is not investing. Think of it like sitting in a becalmed ship. You can have all the patience in the world, but if the wind does not blow, you are not moving.
You are waiting for weather that the sector itself is fundamentally incapable of generating.
Exactly.
But wait, even if we lack a specific macro catalyst at a given moment, taking a contrarian position is still an exercise in bounded risk management.
Bounded risk?
Yes, the contrarian stance is rarely an all-or-nothing wager. It is a systematic process of trimming exposure to the most extended areas of the market and reallocating to the most neglected.
To protect the broader portfolio?
Exactly. If you are early to a rotation, or even if you are wrong for a period, your contrarian underweights represent small, calculated risks. By deliberately moving away from extreme valuations, you're insulating the portfolio from a severe drawdown when that inevitable exogenous catalyst finally arrives.
That defense relies on a profound misunderstanding of the mathematics of concentration.
The cost of being early should be acceptable because the risk parameters are strictly controlled by the nature of asset allocation itself.
The difference between bounded risk and catastrophic risk is exactly where this strategy breaks down. Let us contrast the math.
Let us hear the math.
At the cross-asset level, the concentration profile is relatively balanced. If your model signals that you should underweight a specific international equity market or a specific bond duration segment, you might drop your exposure from a baseline of, say, 11% down to 3%.
That is an 8 percentage point gap.
Exactly. If that asset continues to rally, the drag on your portfolio is mathematically bounded by that 8% gap. It is a paper cut. It hurts your relative performance slightly, but your portfolio survives to play another day.
Okay, but what about the modern S&P 500?
The technology sector is not an 11% allocation. It is 32% of the entire index.
32%.
To execute a contrarian strategy, to systematically fade the most expensive sector, means you must dramatically underweight that 32% behemoth. You might drop your weight from 32% down to 2%.
That is a massive 30 percentage point swing.
We must let the reality of that number sink in. Missing out on a 30% index weight when that specific sector is compounding at positive 56% in a single year causes unrecoverable drag.
That is how you mathematically arrive at the negative 15.8 percentage point penalty in 2023.
Yes, it ceases to be a bounded hedge. It becomes a portfolio-destroying amputation. You have surgically removed the primary engine of market returns.
But the resulting performance deficit? Surely it can be recovered elsewhere?
The deficit is so deep that no amount of compounding in your remaining cheap assets can ever mathematically bridge the gap.
But wait, you are reallocating that capital into defensive havens. The other side of that amputation is the downside protection you acquire, which is where contrarians historically make their money.
Downside protection against the 32% leader?
Yes, it is true that you miss the terminal stages of a speculative melt-up, and you sacrifice the explosive upside of a 32% sector weight.
A massive sacrifice.
However, by moving that capital into defensive, fundamentally cheap sectors like consumer staples or utilities, you are compounding small, safe wins. You are accumulating yield and preserving capital.
Over a complete market cycle.
Exactly, which includes both the expansion and the inevitable contraction. Avoiding the massive drawdown of the overvalued sector and clipping the steady returns of the undervalued sectors results in superior risk-adjusted performance.
You believe it is a different distribution of returns.
One that ultimately favors the contrarian who avoids the devastating tail risk of a concentrated bubble.
That sounds incredibly prudent in theory, but when we look at the actual math of how those returns are distributed, the safe wins are mathematically incapable of covering the losses.
Incapable.
We need to introduce the contrarian return decomposition equation. Let us translate it into the physical reality of managing a portfolio. Think of this equation like swimming against a massive rip current.
Okay, a rip current. Walk me through the formula?
The formula is negative beta multiplied by the trend drag plus theta multiplied by the reversion gain.
Let us break that down.
The first part, the negative beta and trend drag, is the rip current pulling you out to sea every single day you bet against a structural trend. The second part, the reversion gain, is the occasional wave that pushes you an inch forward toward the shore.
And you were saying the modern sector environment changes the balance of those two forces.
The mathematical reality dictates that the rip current is enormous and continuous, while the forward waves are minuscule and rare. Look at the actual excess returns.
When technology wins.
When technology wins, it produces frequent and explosive excess returns. Positive 30.2%, positive 25.6%, positive 18.9%.
Those are violent, massive moves.
Now look at the defensive sectors you were using for shelter. When consumer staples win, they produce infrequent, tiny excess returns. Positive 5.8%, positive 4.7%.
So the contrarian is forced into a return profile consisting of small, rare wins against large, frequent losses.
You are trading away 30% upside for the chance to capture 5% upside. When the trend drag exceeds the reversion game, which is the permanent state of a structural winner environment, the mathematics dictate that the contrarian literally cannot win over time.
You slowly bleed to death while waiting for a crash?
A crash that mathematically will not generate enough positive return in your defensive sectors to offset the years of drag you have already absorbed.
It is not just about absolute return, though. It is about decorrelating the portfolio.
Decorrelating?
Yes, modern portfolio theory is built on the premise that combining non-correlated assets improves the overall risk profile, even if the absolute returns of consumer staples lag behind technology in a bull market. Moving capital from a highly volatile, highly concentrated sector into a stable, low-beta sector must surely optimize the portfolio.
You think it fundamentally alters the correlation structure?
It does. By introducing assets that do not move in lockstep with the primary driver of the index, you dampen volatility and smooth the equity curve. That decorrelation is the hidden value of the contrarian sector rotation. You are creating a structural shock absorber for when that rip current finally reverses.
The shock absorber you are describing is entirely illusory.
Illusory? The data supports sector rotation for volatility management.
The fundamental misunderstanding of sector correlation structures traps so many investors. At the cross-asset level, you obtain genuine diversification.
Sure, the correlation of gold to the broader equity market is roughly 0.05. It is essentially non-correlated.
And the correlation of long-duration treasuries to the equity market is roughly negative 0.30. It moves inversely. When you rotate capital at that level, you are genuinely altering the risk profile of your portfolio. You are buying true diversification.
But within the sector framework,
You are trapped inside the equity beta envelope. The correlation of the technology sector to the broader market is 0.95. It essentially is the market.
right, because of its size.
Now look at the so-called defensive safe havens. The correlation of consumer staples to the broader market is 0.65.
that is highly correlated.
Rotating out of technology and into consumer staples does not change your underlying risk profile in a meaningful way. You are still deeply tethered to the broader equity market.
But staples would surely draw down less in a systemic shock.
If the broader market experiences a systemic shock, consumer staples will also draw down violently. You have not purchased diversification. You have simply purchased a geometrically inferior version of the exact same equity risk.
You have retained the systemic downside exposure, but you have mathematically captured upside potential.
Exactly. That is not diversification. That is self-sabotage.
But at the very bottom, a low valuation score guarantees a margin of safety.
Does it?
If a sector screens as extremely cheap, if it is sitting in the bottom percentile of historical valuation metrics, it represents a tangible claim on future cash flows at a discounted price. The blindness of the broader market to that value does not negate its existence.
But a low percentile score does not inherently mean safety at the sector level.
A low percentile score must mean an asset is on sale. The cash flows are real, the dividends are real. When an asset class hits these extreme valuation percentiles, we know it represents an asymmetrical buying opportunity.
At the asset class level, yes.
So why should that fundamental principle of finance disappear, simply because we are looking at a subset of the equity market rather than the market as a whole? Cheap is cheap, and acquiring cash-producing assets at deep discount is the most proven mechanism for long-term wealth creation.
Because at the sector level, the definition of cheap loses its informational integrity. The valuation metric itself becomes blind.
How can a raw number be blind?
When a broad asset class, like international equities or commodities, hits a low historical percentile, it almost universally implies a cyclical underperformance that will eventually reverse. The asset class is temporarily out of favor, but it is not permanently structurally impaired.
But at the sector level,
At the sector level, a low valuation score is fundamentally ambiguous. It contains no distinguishing information about the nature of the distress.
so a cheap sector could indeed be experiencing a temporary cyclical dip.
Exactly, like financials in the immediate aftermath of the 2020 disruption. They were cyclically cheap, and they recovered when the yield curve began to normalize. But, and this is the fatal flaw, a cheap sector could also be experiencing permanent structural decline.
Like brick-and-mortar retail companies being systematically destroyed by e-commerce over the last decade.
Yes, their valuations compressed, they screen as incredibly cheap, they hit the lowest percentiles in history, but they were not on sale, they were dying.
So the raw contrarian arbitrage score cannot distinguish between cyclical pain and permanent structural impairment.
Not without external regime information. When you buy cheap blindly at the sector level, you are not accumulating discounted cash flows. You are catching falling knives in industries that are being technologically or demographically eradicated.
Okay, we have mapped out a series of vulnerabilities here. We have the structural nature of the trend, the reliance on exogenous macro catalysts, the extreme concentration penalty, the asymmetric return distribution, the illusion of correlation, and the ambiguity of the value signal itself.
It is a devastating combination.
If we synthesize these realities, we need to build a framework to understand exactly where contrarian investing is mathematically viable and where it is destined to fail.
We must establish the matrix of preconditions that allow the contrarian philosophy to function.
We cannot simply state that it works in one area and fails in another without defining the exact preconditions that govern those outcomes. There must be a structural logic that dictates the boundary line between success and failure.
The matrix consists of three absolute preconditions. We must walk through them sequentially because they form the taxonomy of investment universes.
Let us hear precondition 1.
Precondition 1, expensive must be temporary. At the cross-asset level, the answer is yes. There is no permanent winner among broad asset classes. At the sector level, the answer is no. Technology has compounded at a structural premium.
Precondition 2.
Catalysts must be automatic. At the cross-asset level, the answer is yes. Structural flows provide constant reversion pressure. At the sector level, the answer is no. Reversion requires a specific macro expansion.
And precondition 3.
The cost of underweighting must be bounded. At the cross-asset level, the answer is yes. The maximum exposure gap is typically around 11%. At the sector level, the answer is no. The dominant sector commands 32% of the index.
The outcome of those three conditions is absolute.
Where all three preconditions hold true, you generate the massive historical outperformance. Where none of the three hold true, the strategy collapses.
This allows us to define the taxonomy of universes.
Yes, type A is an environment with no structural winner, which allows contrarian logic to work flawlessly.
Type B is an environment with one dominant structural winner, which explicitly defines modern equity sectors.
And contrarian logic completely fails there. Type C is an environment with multiple structural winners, leading to partial failure as the drag is spread across various underweights. We are currently operating in a pure Type B universe.
I accept the Type B classification, but history proves that Type B environments are not permanent states of nature. If there is a dominant structural winner, financial history guarantees that it will eventually die.
You are returning to the patience argument.
Every empire falls. This is where the true patience argument solidifies. If we look at the historical life cycle of these structural winners, we see a recurring pattern of dominance followed by absolute collapse.
Let us dwell on this history, then.
Let us, because it is the foundation of the long-term contrarian worldview. Consider Japanese equities. From 1970 to 1989, they went on a 20-year run of absolute dominance. They swelled to consume 45% of the global index.
45% is staggering.
They were the ultimate structural winner, and people thought the trend would never end. And then the asset bubble burst, demographics inverted, and they were killed. It took over 30 years for that market to even approach recovery.
What about energy?
Consider the energy sector. From 1970 to 1980, a 10-year run of dominance, reaching 28% of the broader market, killed by the collapse in global oil prices, a 20-year recovery period.
And financials.
From 1995 to 2007, a 12-year run, hitting 22% of the index, killed by the subprime mortgage crisis. It required 15 years to recover its relative peak.
Which brings us to technology.
Technology itself has gone through this before. Tech version 1, from 1995 to 2000, a rapid 5-year run, peaking at 35% of the market, healed by the dot-com bust, followed by a grueling 15-year recovery.
And now we are in tech version 2.
From 2010 to the present, a 15-year run, currently sitting at 32% of the index. The ending of this current era is blank. It is in progress.
But the historical precedent is unbroken.
A dominant winner emerges, it dominates the index weight, and then it is structurally impaired for decades. The patient contrarian is positioning for the inevitable collapse of tech version 2. The skeptics looked incredibly foolish in 1999, right before the bubble burst. Gravity always wins.
Your historical masterclass is accurate in its data, but fatally flawed in its application to actual portfolio management. You have walked directly into the time horizon paradox.
The time horizon paradox?
Yes. Structural winners eventually die. If your investment horizon is 30 years and you have infinite capital, zero client pressure, and no career risk, you can wait for the collapse.
Most people do not have 30 years.
Let us look at the psychological and mathematical reality of time. In the short term, from 1 to 12 months, trend drag completely dominates the return profile. In the medium term, from 1 to 3 years, you experience cyclical corrections, but the structural trend quickly resumes.
It takes 10 to 15 years for the structural winner to exhaust itself and collapse.
Here is the fatal flaw in your reliance on history. Almost no investor operates on a 15-year time frame. Institutional mandates, client patience, career longevity, and capital reserves are all calibrated to a 1 to 36-month horizon.
Imagine being the portfolio manager who correctly identifies the structural bubble in year 4 of a 15-year cycle.
You position contrarian, you underweight the winner. By year 6, you are underperforming the benchmark by double digits. Your clients redeem their capital. Your firm fires you.
You were philosophically right about the eventual collapse, but you are professionally dead.
You run out of money and you lose your job long before the 15-year structural winner finally breaks. Patience is not enough if your required time frame fundamentally mismatches the life cycle of the asset you are betting against. You cannot survive a decade of negative trend drag.
But while we wait for that ultimate structural turn, we are seeking shelter in the remaining sectors. If the structural winner takes 15 years to peak, we must evaluate the degradation rate of the alternative sectors we are holding.
Which moves us from decades-long life cycles to the immediate, measurable decay rates of the individual sectors.
We need to examine the half-life of these sectors to understand exactly what happens to capital when it is parked outside the dominant structural winner. We are actively measuring how long a sector retains its relative strength. And we can measure that precisely using the sector half-lives data. This is the microscopic proof of the macroscopic problem we just discussed. It details the extreme variance in how quickly these sectors decay relative to the broader market.
And it shows how capital physically drains from the rest of the market to feed the winner.
Let us look at the fast decay sectors. Industrials have a half-life of just 47 days, with a slightly positive trend of 0.3%. Consumer discretionary has a half-life of 50 days, but with a deeply negative structural trend of negative 4.7%.
Financials decay in 57 days with a negative 1.2% trend.
Real estate decays in 60 days with a catastrophic negative 10.7% trend. Now let us look at the slow decay sectors, the very places a contrarian tries to hide.
Healthcare has a half-life of 111 days, but it carries a negative 7.3% structural trend.
Consumer staples, 116 days, negative 6.6%. Utilities, 142 days, negative 3.8%. Contrast all of this with the structural winner.
Technology, which drives a positive 3.9% structural trend.
The analysis here is brutal. The defensive sectors you want to hide in, staples, utilities, healthcare, do indeed move slower. They have long half-lives, but they possess deeply negative structural trends relative to the market.
You are not preserving capital in a safe harbor.
You are experiencing a slow bleed. Capital is mechanically flowing out of your defensive holdings to chase the momentum of the structural winner. You have engineered a portfolio that is mathematically guaranteed to slowly decay while the market leader compounds rapidly.
We have systematically deconstructed every rationale for employing this strategy at the sector level. The mathematics are explicitly, demonstrably terrible.
The concentration drag is an amputation, the return distribution is hostile, the correlation benefits are false, and the defensive alternatives are structurally bleeding out. This leads to the ultimate question, the true intellectual mystery of this entire analysis. If the data is this clear, and the structural disadvantages are this profound, why do so many highly intelligent, highly resourced institutional investors still deploy this exact strategy?
It is a great question.
These are not amateurs. They command billions of dollars and employ armies of analysts. Why do they continue to rotate sectors based on simple valuation percentiles? Are they completely blind to the mathematics of the structural winner? They are not mathematically blind. They are, computationally restricted. This is the intellectual revelation of our entire analysis. We have identified several distinct causes of contrarian failure today.
Right, we just laid them all out.
We must now realize that these causes are not just a list of grievances. They represent a computational equation that the market is failing to process. This is the 6-bit information problem.
The 6-bit information problem. I want you to feel the weight of this realization because it is a profound paradigm shift.
Every investment decision requires processing information to clear ambiguity. Each of the structural realities we discussed corresponds to one binary question that must be answered correctly to generate alpha. We must map these bits slowly.
Let us go through them. Bit 1?
Bit 1, is the cheap valuation cyclical or is it structural? Most market participants stop their analysis right here.
Bit 2?
Bit 2, does the required mean reversion have macroeconomic confirmation? A sophisticated analyst might check this.
Bit 3?
Bit 3, what is the exact mathematical cost of underweighting a 32% market leader? Very few models compute this asymmetric drag correctly.
Bit 4?
Is the return distribution skew positive or negative?
Bit 5?
Does the proposed rotation produce genuine mathematical decorrelation from the equity beta?
And finally, bit 6.
Bit 6, is the underlying asset experiencing a temporary dip or permanent impairment? That requires external regime identification. The total complexity of this environment requires processing 6 bits of information.
The probability of guessing all 6 correctly by random chance is 1 in 64.
4.6 bits, giving them a much higher efficiency rate.
But here is the most profound realization, the absolute kill shot to the institutional contrarian approach.
Institutional investors are not stupid. They are legally blindfolded. Style-mandated funds, pure value funds, dedicated contrarian funds literally zero out bits 1, 3, and 6 by their very charter.
They are legally prohibited from questioning if the decline is structural. If it meets the value criteria, they must buy it.
They are legally forced to ignore the concentration drag of underweighting the market leader. Their mandate limits their tracking error or sector weights.
They are legally required to buy cheap assets, regardless of permanent impairment.
They are legally forced to live in a 3-bit world while trying to solve a 6-bit problem.
So the persistent failure is not a lack of intelligence, but a structurally enforced cognitive deficit. The mandates themselves prevent the necessary computation. Billions of dollars are legally obligated to ignore reality.
Precisely, which brings us to a testable hypothesis. Contrarian alpha is strictly proportional to the information gap between the actual regime complexity, which is 6 bits, and the cognitive computation the investor is allowed to deploy.
If your mandate restricts you to 3 bits of processing, your alpha will be negative in a 6-bit environment.
You are mathematically guaranteed to fail, and your charter demands that you execute that failure repeatedly.
The sheer weight of that cognitive computation gap is devastating. The realization that entire tranches of institutional capital are legally mandated to fail because they cannot process the full 6-bit reality of a structural winner universe fundamentally alters how we must view sector rotation.
It changes everything.
I concede the mathematical reality you have presented. Pure contrarianism, relying solely on valuation percentiles at the sector level, is functionally broken under the current market structures. The concentration drag of the 32% structural leader, combined with the slow structural decay of the defensive sectors, creates an insurmountable hurdle for a strategy limited to 3 bits of information.
It is good to hear you admit that.
However, I remain philosophically tethered to the belief that historical life cycles cannot be permanently suspended. The 15-year run of our current structural winner will eventually encounter its terminal catalyst, and the underlying cycle will reassert itself.
But the timing?
The gravity of extreme multiples will eventually break the trend. The question for the listener is whether enduring a decade of systemic performance drag and the severe career risk that accompanies it is a price worth paying to be correct on that final inevitable turn.
We have established that the raw contrarian signal is fatally flawed without external context.
Therefore, the only path forward is to introduce an external mechanism that can process those missing bits of information and correctly identify the macro regime. That is the exact challenge we will tackle next time, where we will take this entire framework and rigorously examine the version 1 regime detector, the very mechanism that attempted to solve this problem, but ultimately whipsawed. This is the Research Desk officially signing off.